All right, guys, so the RSI, or the Relative Strength Index, I personally don't use this too much, but Tom uses it quite a lot. So he's going to walk you through it on the charts. The RSI is almost like the market's heart rate monitor. If the market's working too hard on the buy side or too hard on the sell side, it may become a little bit overbought or a little bit oversold. And if you could understand and decipher the RSI, it can give you a clear indication of whether we may reverse or not. So it is a really, really, really effective indicator to use if you know how to use it properly. And Tom certainly does. So he's going to walk you through it on the charts now. So I hope you enjoy this episode, and I'll see you in the next one.
Hi everyone. So in this new video, we will look at RSI and divergences for RSI. So let's go into a very simple definition, which we literally just got from Google. It's essentially the relative strength index. It's this metric down here. So looking at the actual just pure definition, RSI measures the speed and magnitude of a security's recent price changes to evaluate overvalued or undervalued conditions in the price of that security. Now, if we look at this for Bitcoin here, we will pull this right up. So essentially what we're looking at in terms of the RSI is this level here. If we see it go high, that essentially means it's overvalued. If we see it go very low on that time frame, it means it's undervalued. So the main measurements are between 30 and 70. Above 70 would suggest overvalued, below 30 would suggest undervalued, anywhere in between, and it's within fair value on that specific time frame. So the RSIs will change depending on what time frame you're on. So let's zoom into this price action wise to just pick out some examples. Again, this is pretty straightforward in terms of the overvalued or undervalued. What we will now look at is what these can mean for us in terms of signals, and they're called divergences. When we look at those divergences, what do they mean? So when I first got into trading, the thing I used was a cheat sheet from Baby Pips. So that was this. So if we look at the regular divergence, we can see a bullish divergence is a lower low in price and a higher low on the oscillator. And a bearish divergence is a higher high and a lower high on the oscillator. So let's have a look at this. So a bullish divergence would be when we have a higher low on the oscillator. So we're looking for somewhere pretty low and a lower low in price. So we probably may not have had one recently. Let's look at the 3-day chart, see if that's any different. So it may be the case that here is one on the 3-day chart. So what we do have is we have a higher low from here to here on the oscillator, but we have a lower low in price. So that's a bullish divergence. A bearish divergence would be the other way. So a bearish divergence would be a lower high and a higher high in price. So we're looking for a lower high and a higher high in price. So if current price moved up into here, say 75k, and the oscillator came up to here 80, for instance, that would be a bearish divergence because you would have a higher high in price from here to here. Let's assume we push up from here to here, and we would have a lower high on the oscillator from here to say here. So that would be the example of a bearish divergence. Now that's a simple understanding of RSI and the divergences and what they mean. Now in terms of actually using them as signal and trading them, it would suggest weakness if we got a bearish divergence because you've got a higher high but not as much momentum to produce that high. So it would actually indicate some weakness. We're in the bullish divergence, so in the higher low on the oscillator, but the lower low in price, that would actually indicate strength, underlying strength. So hence that would be a signal for the market to potentially go higher. Now it does get more complicated when you get into hidden divergences. So let's go through that. And again, I used this cheat sheet when I was starting out a lot. So if we look at hidden divergence, a bullish hidden divergence is a higher low but a lower low on the oscillator. So essentially you're looking for a higher low in price but a lower low on the oscillator. You have to really zoom in to see this. I'll use this example rather than trying to go find some from the chart. But yeah, essentially that's a higher low in price but a lower low on the oscillator. That would actually be bullish as a signal. So if you saw that, you would then expect the market to potentially run higher from there. If we're looking at the bearish side now, a hidden bearish divergence, that would be a lower high in price, but a higher high on the oscillator. Now, these are not as common, but essentially they would be a bearish signal. Now, this is the slightly more complicated version, and once you get very, clued up with the simple divergences or the standard divergences, which is just a bullish and bearish, bullish being a lower low in price and a higher low on the oscillator, bearish being a higher high in price but a lower high on the oscillator, usually in overbought territory. These are the ones to really stick to and use as trading signals. Again, when I first started, I would get the cheat sheet up. It would always be as a saved tab, and that's how I started to pick it up and learn it. And then I would just go through and start looking at the prices, start looking at the indicators and saying, okay, when have we got something that doesn't match when price doesn't match the indicator? For instance, if we do put in that higher high, but we don't have a higher high on the oscillator, that doesn't match. So then that would likely be some form of divergence. And as we know, that would be a bearish divergence, a standard bearish divergence. So it's almost, when you're looking at price, does it match up to the indicator? Now, I will say this, if we go into the 3-day time frame and we go into the prior bull market on price, we can see that we'll even go to the daily. Now, this won't make too much sense here because it's very zoomed in, but what you can see is in late 2020, early 2021, you can be in overbought or overvalued conditions for a very long time, just putting in highs, new lows, but in this level above 70. So don't think that when you get really overbought that is an immediate sell signal. What you can do is just see price consolidate for a few days, which in turn will reset that indicator down slightly, and then price will make a next high again, and the indicator will pop up again. Price might consolidate, bringing the indicator down, and then price goes up again from there. So just because you see an overvalued signal on the RSI does not then mean that price will definitely go down. It may just mean that prices consolidate first before making another leg higher, and in that price consolidation, that might be enough for this RSI metric to pull down very slightly. So go back test it, have a look at prior price action, and see and pair that against the RSI to help give you a sort of stronger feel for how the two interact, or just the relationship they have with each other based on how prices move. That's it for the RSI.
All right, guys, so you can see how effective the RSI can be. Obviously, Tom uses it quite a lot. I personally don't. Like all indicators, it is dependent on the individual trader. But regardless, you should have a go, take a look, and see if you want to use it yourself. Anyway, I hope you enjoyed the episode, and I'll see you in the next one.